You are 27 years old and you think you understand money because you have never missed a payment. You earn $58,000 a year as a project manager at a construction firm in Denver. You budget, you save, you contribute to your 401k. Every month you have $450 left over and you put it in savings. You feel responsible. You feel ahead. You have no idea how much that feeling is costing you. Your savings account pays 0.35% annually. Inflation is running at 3.2%. Every month you deposit money into that account, you are losing purchasing power and calling it discipline. The $11,000 you have saved over 3 years has not grown. In real terms, it has quietly shrunk by roughly $900. The number on the screen went up, the value went down. Nobody told you these are two different things. Your 401k is in a target date fund. Someone else made every allocation decision inside it, a formula calibrated for median outcomes and a median life you may not be living. You are 27. Time is the single most valuable asset in investing, and you're not using it. You are renting it to a default setting. The car lease felt like $389 a month. It is $389 a month for 36 months, with nothing at the end. No equity, no asset. In 10 years, you will have spent $46,000 on vehicles and own nothing. Someone your age spent that same $46,000 differently. We will get to them. This is the version of your life where nobody explained the rules. They were always there, written in language you were never taught to read. Across town, someone your age is doing something different, not earning more, not working harder, reading differently. They know that a savings account is not an investment, it is a waiting room. They know that the difference between investing $400 a month starting at 25 versus 35 is not 10 years. At a 7% average annual return, it is $560,000 by retirement. The cost of waiting is not linear, it compounds, and it runs in both directions. Then something happens. It doesn't arrive as an opportunity, it arrives as a phone call from your father.
He is 61. He tells you he and your mother are not sure they can retire at 65. The pension he expected was frozen 12 years ago. He has $190,000 in a 401k. He has $2,100 a month in projected Social Security. He has a mortgage with 9 years left. He does not have enough. He worked for 38 years and he does not have enough, and he is only now doing the math. You sit with that for a long time. That night, you open a spreadsheet, not to budget, but to project. You run your own numbers forward to 65. At your current trajectory, you arrive with approximately $340,000 in investable assets. A 4% withdrawal rate generates $13,600 a year from that balance, $1,133 a month before tax. You will have spent 40 years working and arrive at the finish line needing to be careful. This is where the two versions of your life split. In the first version, the one without the knowledge, you close the spreadsheet because the numbers are frightening and you don't know what to do with fear you can't act on. You raise your 401k contribution to 6% because it feels like doing something. You buy 3 shares of a company you recognize. The market dips, you sell at a loss, and you don't try again for 2 years. The moment passes. The curve does not wait. You are 45 when a colleague mentions he bought a duplex at 31, lives in one unit, and lets the tenant cover most of his mortgage. He is not wealthy. He is not a professional investor. He simply understood one thing at 31 that you did not, that your largest monthly expense could be restructured into a partial asset. You file that away, you do not act on it. The window is not closed, but it is narrowing every year. You retire at 67 with $490,000, enough to survive if nothing goes wrong, if the market performs, if you stay healthy, if the roof and the transmission don't fail in the same year. You built yourself a margin of 0. In the second version, the one where your father's phone call became a turning point instead of just a wait, you do not close the spreadsheet. You stay with the discomfort long enough to let it become information.
You spend 4 months reading systematically, not articles, frameworks. You learn that your employer match is a 50 to 100% instant return, and you have been leaving part of it unclaimed. You fix that first. You open a Roth IRA and max it. You move your emergency fund to a high-yield savings account paying 4.8%. That single move adds $500 a year on the same $11,000, doing nothing differently except sitting somewhere better. You stop leasing. You buy a 3-year-old car with cash. The payment is zero. Then you do something that changes the trajectory permanently. At 29, you buy a small 2-unit property outside Denver. You live in 1 unit. The tenant covers $1,050 of your $1,340 mortgage. Your housing cost drops from $1,400 in rent to $290 a month. That $1,110 difference goes into your investment accounts every single month from that point forward. One restructured expense, compounding for the next 30 years. By 35, the property has appreciated 31%. You pull $40,000 in equity and use it as a down payment on a second rental that cash flows $420 a month after expenses. You now have 2 assets compounding simultaneously, one in real estate, one in the market, while your tenants fund a significant portion of both. You are not a real estate mogul. You are someone who understood one principle at 29, that your largest liability could be restructured into a partial asset. That single decision is worth more to your net worth at 55 than every raise you will ever negotiate. Then, the market drops. You are 37. Your portfolio falls 24% in 11 months. This is the moment most investors destroy a decade of progress. You do not sell. You understand that a loss only becomes real when you realize it. On paper, you were down $61,000. In reality, you hold the same number of shares you held before, shares in companies that will recover if the economy continues functioning as it has for the past century. You hold. You buy more. The dip ends. The portfolio recovers and exceeds its previous high within 26 months. Discipline kept you saving. Knowledge kept you invested. By 45, your net worth crosses $800,000. Not because you earned more than your peers, because the same dollars moved through a different architecture.
You think about your father, about the phone call at 27 that could have remained only a sadness. You've had a different version of that conversation since, not about his situation, but about your cousins who are 24 and 22 and still early enough that the entire curve works in their favor. You sat with them for 2 hours. You showed them the spreadsheet. You handed them the first piece. Here it is. Every dollar you earn is either building an asset, servicing a liability, or sitting still. And in an inflationary economy, sitting still is a slow form of losing. That is the entire framework. The 401k question is a version of it. The car lease question is a version of it. The savings account question is a version of it. The rental property question is a version of it. Once you see every financial decision through that lens, is this dollar building, servicing, or sitting? The right moves stop being invisible. Most people make financial decisions by feel, by habit, by whatever the default setting suggests. The system was never designed to explain itself to you. That asymmetry has always been someone else's advantage. Somewhere right now, someone your age is leaving the employer match unclaimed, paying 6.8% on a loan while saving at 0.4%, leasing a car they will hand back in 36 months and own nothing. They are not careless, they are uninformed, and the difference between those two things compounds every single month. The rules were always there, the math was always available, the framework was always learnable. You just needed someone to hand you the first piece.